Nonpartisan tax legislation presentation. What we're here to talk about tonight really is some of the proposals that are making their way through Congress and how they may affect us tax-wise. Hopefully you're all in the right room. I'm John Van Welden. I know some of you, for others, I am John Van Welden, I promise. Founder and president, Van Welden Financial Group. We're located right up the street here in Old Westchester. As a means for a little bit of housekeeping, refreshments are at the back. Water, if you get thirsty or hungry while we're doing this, feel free to go ahead and make your way back there. Restrooms are down this hall, first left if you need to go. We will have a break more than halfway through, but somewhere around halfway through, so you can also go then. I will ask you to silence your cell phones because otherwise, without exception, we'll get a text or a phone call or something. I'm also going to ask you to keep your questions general because, number one, I can't possibly give you advice in this class. I don't know anything about most of your situations. And also, I don't want to take time answering one specific person's question about their particular situation, so everybody else has to sit and listen and it doesn't pertain to them. If you have specific questions, or if you want a second opinion on retirement planning, that's what we do. I'll talk about that in a minute. You're welcome to schedule a complimentary strategy session, whether it's real brief and you just have a couple questions related to your situation, fine. Whether you want to review everything and get more detailed, that's fine too. There's no strings attached, but that's kind of where we can address your specific unique questions. All right, disclosures. You can all read, so I'm only going to highlight the last three, and that is to say that this is for educational purposes only. This is not advice, so don't leave here and do anything because you think I told you to do it, because I'm not going to tell anybody to do anything. Seek professional guidance before implementing any of the strategies we discussed. Other than that, everything else is just to make the lawyers happy. A little bit about us, Van Welden Financial Group, just so you have some perspective where we're coming from and why we do tax. We do tax seminars, we do Medicare classes, we do Social Security classes, and this will give you a little bit of an understanding of why we do those and kind of what our DNA is. Again, we're located right up the street in Old Westchester. We've been doing retirement planning for over 23 years. What makes us different, I always tell people, are three things. One, we are very much truly independent. We're not affiliated with a broker-dealer, a money manager, a bank, a credit union, an insurance company, a mutual fund company, or anything like that. We don't have products that we manufacture that we're trying to sell. We're fee only, and we are accredited fiduciaries. Secondly, we're very focused when it comes to retirement. Our niche is people within about 5 years of retirement, all the way in through retirement. And by focusing on retirement, the two things we care most about are lifetime income stability and asset preservation. And it's kind of self-evident how paying less taxes kind of plays into that, right? It's not how much income you get, it's how much you keep, right? And asset preservation, it certainly helps if you're paying less taxes versus more. I always joke and tell people, we're not here to make you rich, we're here to make sure you're never poor. And then lastly, we're truly holistic. So when most people will say they're comprehensive or holistic planners, but the vast majority of people in our space focus on investment planning because, let's face it, that's how people in our industry get paid. But we really pull in the income planning, the tax planning, survivor and legacy planning, and healthcare planning, because we feel like if we don't do those well, and if you don't have all that integrated, then even if your investment planning is done well, you can have a lot of shortcomings in retirement. So that's kind of who we are, what our mindset is. Tonight, our agenda is going to be pretty darn simple. We're going to talk about the Biden administration's proposed tax legislation, and specifically two areas: how your income may be taxed, how your assets may be taxed, and what, if anything, you can do about it. Now, of course, this is all proposed, so it's somewhat conjecture, but a lot of this is fairly clear because we've been told. One of the things you have to understand, and most of you are probably aware of this, but right now we have single party control of the House, of the Senate, and of the presidency. And when that happens, the theory is that it's more likely that that party's legislation is going to get through. So that's part of the reason we're kind of looking at these things, even though they're right now still being proposed. And what we've been told is that the Tax Cut and Jobs Act that came from the last administration and the changes to the Affordable Health Care Act are both squarely in the crosshairs. So a lot of changes related to those particular acts. And what we're talking about is going to be called the Budget Reconciliation Bill. So we don't know exactly how that'll look, but we know a lot of information about, you know, what the Democratic Party wants it to look like. So, more specifically, here's some areas we're going to talk about tonight. We're going to talk, and the things in red are in red because every single person in this room, those apply to. The things in black are in black because they may or may not apply to you. And I would encourage you, even if they don't apply to you, to kind of pay attention, because remember, these numbers can all change. And as soon as we think, oh, my income's here and that only applies to people with their income here, then a year later you wake up and you find out they kind of changed the rules and now it applies to me and I didn't pay attention. Or, quite frankly, you might know someone who should be paying attention to these things. So, number one, increased taxes on all incomes over $9,000. A 6.2 payroll tax increase for the higher earners. And of course, I left it higher because in proposals like this, you don't ever know until it's done what higher means, right? The definition of higher today may change by the time it's passed. A limit on itemized deductions of 28% for high-income taxpayers. An elimination of the step-up in basis. That's another one that will affect everybody in this room, most likely. Federal estate tax exemption of $3.5 million, $7 million joint, and long-term capital gains and qualified dividends taxed at ordinary income rates for higher earners. So we're going to go through all this, but that's kind of a big picture of what we're going to touch on. So let's start with something that will affect everybody, and that is tax rates. What they're proposing to do with the tax brackets. You can see we have the 2021 tax brackets right here, or at least 21 for right now. And then we have the proposed tax brackets to the right, whether you're single or married. And without getting into a lot of detail, because we don't need to do that right now, you can see two things. You can see that the next highest tax bracket starts sooner, if that makes sense. And you can see that some of the larger tax brackets are also bigger. So what the higher tax brackets are bigger. Meaning that just about at any level of earnings over $93.25, you're likely to see a tax increase based on this legislation if it goes through the way it is. Secondly, current payroll tax. So payroll tax, the way it works is the employer pays about 6.2% and the employee pays about 6.2% for a total of 12.4%. And if you think about it, that's a hefty chunk. It may be that only 6% comes out of your paycheck, but that's 12% of your payroll going toward Social Security. But it's only applicable to the first $143,000 that you earn. If you earn more than that, then you don't continue to pay Social Security, you or the employer. Medicare is a little different. It's 1.45% for each the employer or employee for a total of 2.9%, but that's not capped. So every dollar you make is taxed that way. So again, we've got 2.9 plus 12.4, so we've got over 15%, and some of that continues as much, regardless of how much money you make. The proposed payroll tax will literally double. So you'll have an extra 6.2% payroll tax increase for higher earners. Again, higher earner yet to be defined, but that's the employer portion, and 12.4 for self-employed. So 6.2 for you and the employer, and if you happen to be a self-employed individual, you're going to get a 12.4% increase on your payroll tax for Social Security and Medicare. And again, that's a big number from my perspective. Okay, so another issue that's being proposed is to limit itemized deductions to 28% for high-income taxpayers. So think about it this way. I just showed you that the tax brackets are going up, right? And so if you happen to be someone whose last dollars earned exceed 28%, then even if you have itemized deductions, remember itemized deductions, the idea is whatever I can deduct and itemize can potentially offset that amount of income, right? That's the whole idea. The problem is if I'm limited to 28% on my itemized deductions, then what happens is if I happen to exceed that threshold in the last dollars I earned, now if I jump into the 32 or 33% tax bracket with my last dollars earned, and my deductions only give me a 28% deduction, now there's 5% or so in there that I'm not going to make up for. So again, it's a way of kind of grabbing an extra few percent. A lot of these things, what I find interesting is, it's one thing when you just change the tax brackets, but in a lot of these things, and we saw this in 2015 with Social Security, it's a little tricky, but rather than just increase the tax rates, what they do is things like this, that are effectively an increase in tax rate for us, but it doesn't appear that way. It doesn't come out and just say, hey, tax rate's going from here to here. That would be simpler. We at least all understand it. Instead, sometimes they'll do things like this, and so you don't see the tax rate itself, but by the time you've calculated your taxes, there's an increase there. So 28% itemized deduction cap. And by the way, we're going to talk about estate taxes and things here in a little while. And one of the things you have to remember is even if you think these will apply to you, when we look at things like inheritances, whether you're receiving an inheritance or leaving an inheritance, with the new rules, and with like the new rules for IRAs, where they can't be stretched out over a lifetime, instead they have to be taken in 10 years, suddenly, even if you're not earning this kind of money, if you're on the back end of an inheritance or if you're leaving an inheritance, you can throw someone into these types of scenarios, even if it's only for a year or two, but the bottom line is that it's still a pretty dramatic tax impact on them. So some of these things you think, oh, that won't apply to me, but it may apply to your heirs, or it may apply to you if you eventually have an inheritance for the years in which you receive it. Okay, so let's talk now for a second about the elimination, something else. So the first screen I talked about, I said it's going to affect everybody. And that's just the increase in the tax rates, right? The second thing that will likely affect all of you, one way or another, either on the giving or the receiving end, is the elimination of the step up in basis. Is anybody familiar with what I mean when I say step up in basis, especially when we're talking about inheritance, right? Estate, okay. So think of it this way. When we do planning, one of the things we do is we're highly focused on the different types of assets that you have and the way those are treated by Uncle Sam, the taxation. Because again, not all money is created equal, and some money is much more efficient than other, especially when you get into retirement. So, for instance, over here we have pre-tax dollars. This is what we've all been encouraged to save over the last 30 years because it's the best money to save, right? In theory, that's what we're told. Because we get a tax deduction. But the problem is it's pretty much the worst money to have in retirement because it's 100% taxable. So this is all pre-tax money, and although it grows tax deferred, when it comes out, it's 100% taxable. So even if I put $1 in and saved 20 cents because I didn't have to pay tax on it, when I pull that out, if it's grown to $4, then I got to pay tax on all $4. And even if it's still 20 cents per dollar, my tax grew as my account grew, right? Does that make sense? And here, and then the second thing I'll say is that assumes the tax rates stay the same. But we're having this class why? Because the tax rates aren't going to stay the same. In the middle, we have what's called post-tax. This is money that you received, you paid taxes on, and then you did something with it. You put it in the bank, you bought stocks or bonds, or you purchased real estate or some other asset. So it's after-tax money, and it's not, you're not taxed because you spend it, but you are taxed from time to time on the growth or interest that it generates. And again, we're not going to get into too much detail there, but you kind of understand after tax. And then you have tax advantage, meaning things like Roths, like cash value life insurance. One thing that's not here is your home equity. Things like that, which are tax advantaged, and I call them tax-free. So the bottom line is when we talk about the elimination of step-up and basis, this stuff is the best money to have in retirement because it's free for me to spend and the growth is free, but it's also free for me to pass on to my beneficiaries. This is the worst money to spend or to pass on because it's not free to anybody. It's always going to be taxed. At the moment when we're speaking, if I have a highly appreciated asset that is after-tax money, when I die, my beneficiary gets a new basis, so they don't have to pay the capital gains taxes on that asset that I might have to pay if I sold it. So, and the change that they're thinking of making is to eliminate the step-up, so that capital gains tax would be due, and you would, the person inheriting your money or your asset would inherit your cost basis. So they would have capital gains taxes due as well. So just to give you an example how this works, and most of you probably already figured it out as I explained it there, is so if Bernie has a post-tax brokerage account with a cost basis of 100 and a market value of $1 million, along with a home valued at $500,000, and he purchased it for $250 20 years ago, right now, his beneficiaries, if he dies and his beneficiaries inherit those assets, they're tax-free. They can sell them the next day and they won't owe a penny of tax. Okay? With the new legislation, same scenario, instead, his cost basis carries to them and they still owe tax on the appreciation of those assets. In this case, they'd have a $1.1 million long-term capital gain, and based on the new legislation, which we haven't gotten to the capital gains part yet, we would be looking at a 39.6% tax rate. So you're looking at a tax due of $435,000, and that is not the estate tax. That's just the capital gains tax. So if it were subject to estate taxes, that'd be over and above. So again, you can see where earlier when I talked about some of the different tax changes, and I said this might feel like it doesn't apply to you, but if you inherit $1.5 million, all of a sudden this all applies to you, the year you inherited, right? And historically, we haven't had to worry about it. So that would be a pretty hefty example. There's a $500,000, well, 400, I like to round, $435,000 tax that wasn't there literally before the legislation. And what this is liable to do is create a lot more permanent life insurance sales, because what people used to do, either before the step-up in basis or when the estate tax exemption was small, is they buy life insurance to cover the taxes on this stuff. Well, because the estate tax exemption has gotten so big, and because of the step up, it had reduced the need for people to have that. So when they finished working and they didn't need life insurance to take care of the family, most people would let their life insurance go. Now I think people will be reconsidering that because they're going to see this big tax bill waiting. Proposed federal estate tax exemption of $3.5 million per individual. Does anybody know what the estate tax exemption is now?
11.
It's just over 11 per individual, 22 for a couple. So this might sound really high, but compared to 11 and 22, it's not. Now, when I first got into this business back in the 90s, does anybody know what the estate tax exemption was then? Is about $650,000. So the way to think of this is, back then, you could pass on $650,000 to whomever you wanted when you died, tax-free, estate tax-free. All the other stuff still matters. If it's an IRA, you still got to pay income tax on it. If the step-up isn't there, you still got to pay gains tax. But this is just estate taxation. Then it went up to about $1 million. Then over time, it's grown to $11 million. And now they're thinking of taking it back down to 3.5. Now, to give you some perspective, if you plan on living another 30 years-ish, the current value, today's value of this $3.5 million is really about a third of that, about 1.2. So if this sounds like I don't really have to worry about this because it's 3.5 and I'm 3.5, you know, if you've got an estate worth somewhere around $1 million between your house and your 401k or whatever else you have, it is feasible, and it's not a real stretch to think that you could eventually be here, because this sounds like a crazy amount of money, but it's really about $1.2 million in today's dollars. So if you think about the fact that your estate could be worth $1 million, all of a sudden you go, you know what, that's not so crazy. And the second thing I'll mention about this is it is $7 million. It's twice that if you're married, right? Because you each get to pass on $3.5 million, but that's not automatic. So if you don't do any planning, and then we always like to, the example we use is if you get run over by the beer truck, because most people aren't real emotional about hearing that. If I say other things, people might go, oh, I know someone who got it. So so far, the beer truck's pretty safe. So if you get run over by the beer truck, you and your spouse, and you haven't done the proper planning, you don't automatically get the 7. Because you only get the 7 is if you properly structured a trust to shelter the first 3.5 and then have the second 3.5 go through the second spouse. So my point there is, this is the number to really focus on. If you do the proper planning, you can get away with 7 for a couple, and anything over that, you're going to get hit with taxes on. And this is very likely to change too, because you see where it came from and where it went. I'm not convinced it's not on the way back down. Okay, so an example here, if you had 11.7 million, 23.4 married, anything above is taxed is 40, individual 3.5, 7 married, anything above is taxed at 40 to 45. They're also raising the highest estate tax bracket. But again, this only comes with planning. It doesn't come automatically. So in case you know somebody who's in that situation. So this is where I said it's about $1.2 million in future dollars today's dollars in the future, and that only occurs if proper planning is done. So just a couple caveats, because I think sometimes people hear the numbers and they go, oh, I don't care about that. All right, so in this case, I think so similar to what we just looked at for capital gains. Now in this case, somebody had a $10 million estate and they died and they had done the proper planning. There is no estate tax, assuming his wife predeceased him and he did the proper planning, had the right trust, he can pass on 10. I'm sorry, I said that wrong. Forget the wife, because in this case, he's under his 11, so no tax. But under the new law, $6.5 million will be subject to estate tax, which is a $2.6 million tax. So again, even if it doesn't apply to me, if I was a person with a $10 million estate, and a good example of this was, in a lot of cases, one spouse, let's say two spouses had a $10 million estate. Well, because of the law with $11 million, they probably didn't worry too much about doing the planning. So let's say one spouse passed away. Now the remaining spouse has the whole $10 million instead of them having each. Well, now they changed the law, and it's not as easy for me to deal with it if now there's just one of me with $10 million. See what I'm saying? So it sounds like no big deal, big problem, you have $10 million, but if they had known, they could have split the estate and done some planning, and then they would have $5 million each, and then they would only have $1.5 million over the exemption. But since they were playing by the rules, if one of them passed away, now the survivor's left with the entire estate. So that's again, this is a big number for, imagine if you do have $10 million, and all of a sudden you wake up tomorrow and you went from no estate tax to $2.6 million in estate tax. That's not a fun surprise. Again, I know it's hard to feel sorry for somebody with $10 million, but the truth is, it is what it is. Whether it's $10 million or whether you have $1 million and you're out $260,000, it's the same thing. Another proposal is long-term capital gains and qualified dividends taxed at ordinary income rates for higher earners. So right now, we have three tax brackets for capital gains. Depending on your income, if you sell an asset that you've held for over a year, you'll either owe no tax on it, 15%, or 20%. And you don't get into the 20% till your income's pretty substantial. But the situation now is they're looking at saying anyone who makes $1 million or more in a year, the proposed capital gains tax is going to be about 40%. Again, we're all like, who cares? That's no big deal. They make over $1 million. But again, remember, I reminded you of that inheritance situation. Somebody dies, receives an inheritance, and really anymore, if you inherit a 401k and a house, you could easily be, plus your personal income, could easily knock you into this bracket. All of a sudden, now you sell anything and you owe 40% tax on it. That's kind of a big deal. So just remember, there are scenarios that can impact. Go ahead.
Oh.
No, you're allowed.
Okay. She said I can't.
Well, she's the boss, so I didn't know. As long as it's not specific to you, as long as it's general, that's okay.
So just to understand the chart again, so the 80,000, say for example, under the 2021, is that a combination of a long-term capital gain and your income, or is that just the long-term capital gain?
No, if your total income exceeds the threshold, then your long-term capital gain tax is applied at that rate. So it includes everything to get you there.
Okay.
So it could be inheritance, it could be W-2 income, it could be IRA distributions, it could be pension, it could be the sale of something that generated income. Make sense? So am I answering your question? So all of those things together, if they get you over a certain threshold, then the tax on that part of it that came from capital gains just shoots up. Does that make sense?
Yeah.
Does it answer your question? I'm not convinced that
Yeah, it does. And I guess still, when you look at these charts, like, is that first 80,000 like 0%, and then when you move into that next range, all of that income in that range?
As soon as you go over, your capital gains tax jumps up. It's not like tax brackets in general, where your first dollars are taxed at this, and then your second dollars are taxed at this. The day you make your 80,000 and first dollar, does that make sense?
Yeah.
Your capital gains, applicable capital gains tax just jumped. All of it.
All of it.
Yeah. Does that make sense?
Yeah.
Different than having an incremental tax, which back on the tax brackets, as you make more money, your first dollars are still taxed at the lower bracket,
gotcha.
right?
Okay.
And here, as soon as your capital gains surpasses that limit, all of your capital gains get penalized. And you have a question?
Related to that, do you know if qualified dividends would add towards that 80,000?
Interestingly enough, that's part of the legislation, and the answer would be yes. They would apply towards that, because qualified dividends have been a big deal for a long time. And I don't know, I'm not going to pretend to know exactly how the current legislation addresses them, but I've heard that the whole idea of qualified dividends is something that they're looking to kind of sort of eliminate. The idea that some dividends are better than others, right? And treat it all more like capital gains. For regular income, pardon me. All right. Okay. So what I just told you were the things that we know are on the table or in the bill in some form or another. There are obviously other things that are on the table, that are potentially going to be on the table, but we don't have as much information on it. It's either because I haven't heard it, or it wasn't something they talked about a lot during the, wasn't part of the platform that they said, hey, if we get elected, here's what we're going to do. What we do know is that this is going crazy. Stimulus is going nuts. And we had a conversation earlier, there's two things the government can do when it comes to money supply, right? They can print money for free out of thin air. Do we all at least agree that that's how it works? I mean, it literally is how it works. I'm not being tongue-in-cheek. They print money. Well, they don't even print it anymore. They just create digital money. But you get what I'm saying. The problem is you can do that and you can cover up a lot of problems. But eventually, what happens as a result of it? If you do it indefinitely, what's the outcome? Inflation. And when inflation happens, what do we need to do? What inflation means is too many dollars chasing too many goods and services, right? So how do we undo inflation? If we're the government, not that I am, but we tax the citizens and pull the money back in. There's no other way. You don't uncreate currency, right? You print it and then you tax it back. That's it. So the more of this happens, the more we can expect that there, and that's why you look at this legislation, you look at what they did in 2015 to Social Security, probably didn't affect people in this room, but they changed some of the spousal claiming strategies back in 2015. Had a dramatic effect on people's total Social Security incomes over their lifetime. But most people didn't notice it because they didn't come out and say we're reducing Social Security. They just said your Social Security check's going to stay the same, but what you and your spouse can do related to each other's work experience is changing. And so it had a pretty dramatic effect. But it's one that most people don't understand, so you kind of get away with it. It's like a backdoor tax. So there are three particular time bombs that are awaiting all of you, regardless of the new tax rules, but in particular with them. Age 70, does anybody know what the age 70 time bomb is that's waiting?
You have to take any distributions that are pending in any type of your 401ks.
Close. That's this now. It was 70 and a half, and they changed it to 72. So you answered question number 2. So that, but that's good. So by 72, you have to start taking required minimum distributions. You have no choice. That's time bomb number 2. That means there's income being forced out that you can't control, and it's taxable. And so we got to do some planning. Let me go back to this one, because this used to be 70 and a half, but what age 70 is the last year you can do what? Turn on Social Security. You can wait till 70, but after that, if you wait, you're just missing out on money. Meaning, by this time, you're going to have another taxable income stream, and that's Social Security, maybe two of them. And then, of course, this one I just discussed with you. I just showed you several ways in which, at death, there's going to be a number of potential tax bills coming due for you or your beneficiaries. So, these three things, in our opinion, are tax time bombs, and you don't wait till you're 70 or 72 or on death's doorstep to address them. So because of those things, tax planning is a critical part of not just what we do, but what we believe all retirees should do, or all people approaching retirement. So what can you do? We're going to discuss 7 things that you can do. And it's these 7. I'm not going to spend a lot of time talking through them on this particular slide, but we will go through them here in a moment. But it's good to know there's 7 so that you'll know how close we are to being done with the list as we go. So I'm gonna go through these one at a time. Number 1, you can own tax-advantaged assets. Okay? Tax-advantaged assets become more valuable than other types of assets as taxes increase, right? They affect some assets more than the other. So there's 2 levels on which we can hold tax-advantaged assets. One is the account level. What do I mean by that? I mean the type of account is tax-advantaged. In this case, Roth IRAs, cash value life insurance, healthcare savings accounts, 529s are 4 of, not the only 4, but 4 of the most common types of accounts, depending on if the rules are followed, that are tax advantaged, right? And I could put up here real estate, home equity, but that's not really an account. But you understand, it's tax advantaged because of the way it's treated when you're making distributions. Does everybody understand the difference between a Roth and a traditional IRA?
Yep.
Generally speaking? Okay, so just to make sure we're on the same page, generally speaking, I either put $1 in a traditional IRA account or a traditional retirement account, and I get to deduct that, so I'm not paying tax on it. But as it grows and grows and grows and grows and grows, my tax bill is growing because I've never paid tax on it. When it's time to take it out in retirement, I will owe tax on the entire amount that I withdraw whenever I withdraw. Versus a Roth, I don't get the upfront deduction, but once it's in that account, it can grow and be worth millions. It doesn't matter how big it grows. It'll never be taxed again for me or my children or my beneficiaries. So that's kind of the difference between a Roth and a traditional. Roth conversions are the act of taking a traditional IRA and converting it to a Roth. It is a taxable event. It's not free. But if you didn't invest in a Roth up front, yes, there's a number of years that have already gone by in which the growth is taxable. But I can freeze that anytime I want by doing the Roth conversion, going ahead and paying the tax so that the remainder of the growth is not taxable. Does that make sense? Everybody following that? There's also something called backdoor conversions, and that's a way of taking money that I may have put in a traditional, say 401k or IRA, that was not able to be deducted. Maybe I over-contributed to one on purpose, and I put more in than I can deduct. So I put some contributions in my traditional Roth or traditional 401k or 403b or whatever it was that were not deductible. I can, if I do it correctly, I can potentially get those funds back out and into a Roth tax-free. So that's called a backdoor Roth conversion. So at the account level, I can use these types of accounts, and I used the Roth as an example because most people are familiar with it. But I can use any of these types of accounts to take advantage of tax-efficient savings and investments. On the asset level, means whether I have a Roth IRA or some other kind of an account, or a brokerage account or whatever, what I hold in that account could be tax advantaged. Some examples would be municipal bonds, which are not taxed at the federal level and potentially not at the state level. Real estate, a lot of times rental real estate, if that's something that you like to invest in, it can be very tax efficient because it's less tax onerous than regular W-2 type income. And MLPs, master limited partnerships, are also types of partnerships that invest in things like oil and gas, sometimes real estate. But the point is, you can create tax efficiencies either by the type of an account you're investing in or by what you're putting in the account. Does that make sense? Two different levels. Another strategy is to spend your worst money first. That's a saying we have. I think we need to trademark that, by the way. Make a note. We're big on spending worst money first. Based on these three funnels, as I mentioned earlier, what's your worst money?
Pre-tax.
Pre-tax. That's your worst money in retirement. So we're big advocates of spending the worst money first, and there's a whole system for how to figure that out and understand the tax implications. But as a general rule, most people have a house here, right? I'm sorry, yeah, a house here. Believe it or not, it's in today's rules, it's after tax. I mean, it's tax efficient. So you have a house here. You've got like savings, maybe brokerage accounts, and you got your 401ks. Most people, without going through any kind of class or anything, what do you think is the last thing they tend to want to grab and spend?
IRA.
Or 401k. This is my security blanket. It's my warm fuzzy. It's the thing I've worked all my life for. It is absolutely the exact opposite of what they should. And it's because we've been trained all our life. Cram it as full as we can and leave it and don't touch it. The problem is it is the time bomb. And so we have to kind of unteach people and help them understand that spending this first may be better, especially if you retire before age 70, because now you've got several years of your lowest tax bracket probably ever. And we know what the tax rates are. So I'd rather pay a low tax rate today, maybe between retirement when I turn on Social Security, than to wait and defer it down the road when I might have a pension, Social Security, and our required minimum distributions, and Congress might have raised taxes too. And I'm like, what was I waiting for? So that's another strategy. Postponing Social Security. This feeds right in to number 2. And again, there's a lot. We have a whole other Social Security class we do. In fact, we have one coming up. I don't know when. When's it coming up?
It's in like a week or so.
A week or two. Okay. So I'm not going to get into a lot of detail with Social Security right now. There's a lot of factors that should go into us making decisions about Social Security. But to paint with a broad brush, one reason to consider deferring Social Security is because, by definition, it's more tax efficient than that first bucket I showed you. And if that's the case, then if I defer it, it allows me to spend some of that first bucket in a lower tax environment. And just to elaborate on that, my IRA is 100% taxable. My Social Security is either 0, 50, or 85% taxable. No matter which of those it is, it's more tax efficient than my IRA, right? My 401k. Secondly, if I defer Social Security, I also get an 8% pay raise every year I do it. And I don't know about you, but I can't guarantee someone's going to make 8% on their money every single year. So it's kind of a nice way to not only be tax efficient, but also to increase the stability of your retirement income throughout life. So postponing Social Security will help you spend your worst money first. Annual loss harvesting is the practice of selling investments and assets that are at a loss. I don't care if your investments are up now. This doesn't include IRAs, because if it's in an IRA, It's not being taxed until you pull it out. So I'm talking about investments that are in after-tax money, after-tax accounts. And this could be something physical like real estate, but most of the time we're talking about things like stocks, bonds, mutual funds, because if they're at a loss, whether my account's up overall or not is irrelevant. You're always going to have some positions that are out of favor. And if they're at a loss and I sell them, I can turn around and buy them back in 30 days, got the same position I had, but what I did is I grabbed a hold, I captured that loss, and I can put it on the shelf so that someday down the road, when I have gains, and I don't want to sell because the capital gains taxes are ridiculous, I can marry the loss and the gain up and they'll offset each other. So I'm accumulating those losses. And quite frankly, depending on your situation and how much you have in different types of accounts, that should be something that you should already be doing or your advisor should already be doing for you if it has a substantial effect on your situation. The loss can carry forward indefinitely, and so it can be used against gains. The opposite is annual gain capturing. So, hey, one of the things we hear all the time is people will come in and they have assets or investments that have appreciated really well, and nobody wants to sell them because of the capital gains. Now, what's the first rule of investing? Everybody should know this. What do? You buy and you sell high. By definition, if you're selling high, what's going to happen? You're going to make money and pay capital gain. So the idea that I don't want to sell because I'm going to have to pay capital gains, it just drives me crazy. I'm like, well, if you wait long enough till it drops back again, maybe you'll lose all your gain and you won't have to pay taxes, right? So in the same way, we tell people sometimes, hey, go ahead and you know, I threaten this often to sing Kenny Rogers, the gambler, right? Know when to walk with. So sell some, pay the tax. We know the rate. It's pretty darn low, relatively speaking, to historically. And I'd rather sell it and diversify or minimize my risk than to stay leveraged in risk because I'm afraid of paying a little bit of tax. But the other thing is, if I do have a gain, then I'm not only reducing my exposure for future losses, I can then use it if I've been stockpiling losses, right? I might have a gain and I go, hey, I have some losses from the last few years that I harvested, so I'm just going to go I'm going to go ahead and take the gain and use that to offset it. But even if you don't have anything to offset it with, I would argue you have to weigh the tax that you're going to pay relative to what is the likelihood that the market corrects and you lose an equal amount that you would have paid in tax, and you still have capital gains stuck in it, right? So it can be worse. So here's the bottom line related to these. Strategically timing your investment income through tax loss and gain harvesting can reap big rewards. Now, we're not big fans of having the tax tail wag the dog. Our firm is very conservative investing-wise, and when people get to retirement, our goal is to make sure that we're not taking too much risk with their money and that we're not going to make the big mistake. So therefore, there are other considerations that may outweigh this, right? I almost said Trump this, but then I realized this is the Biden tax that might outweigh this. So again, this isn't in a vacuum. So we kind of have to look at both. But as relates to this, it is important to understand not to ignore it anyway. There may be bigger issues going on in the market that override the tax implications. But at least don't ignore them. Okay, so we're going to take a quick break. This is kind of sort of the halfway point. Here's the thing we want to do now.